Hi, my name is Karan, and in this edition of Unjargoned, we want to cover a metric that is key to understand the core performance of a business: EBITDA. EBITDA, or earnings before deducting interest, tax, depreciation, and amortization, is a measure of company's financial performance independent of its capital structure and its capex decisions. It highlights how much of a company's top line is retained after factoring in expenses related to its core operations. However, EBITDA may not be the right metric to compare companies from the same industry if the operational structures differ significantly. In such cases, we can use something called adjusted EBITDA as a more suitable basis for comparison. Well, it does not differ too much from a traditional EBITDA, with adjustments to just exclude extraordinary and non-recurring items. Take two large retailers in the market right now, DMart and Reliance Retail. DMart stores are company owned, whereas Reliance retail stores are rented. Despite being in the same industry, it would not be an apple-to-apple comparison if we benchmark their EBITDA, as rent is an expense that impacts EBITDA of Reliance Retail, whereas DMart, having spent heavily on capex, will have a higher depreciation instead. This falls below the line of EBITDA. Anybody comparing these companies purely on EBITDA would come to a wrong conclusion. To make these two companies comparable, we would have to use either earnings before tax or EBITDA adjusted with rent, simply by deducting rent from the EBITDA and then comparing them together. The growing popularity of adjusted EBITDA is highlighted in a recent news headline. Zomato turns adjusted EBITDA positive in Q4 2023. Blinkit still in red. A closer look at the numbers would reveal that Zomato's is adjusted EBITDA positive only in its food delivery segment, while all other segments have reported a loss at an adjusted EBITDA level. Zomato adjusts its EBITDA to exclude ESOP expenses, considering it as an extraordinary item. Adjusted EBITDA enables Zomato to portray its actual performance, setting aside abnormalities. Other similar headlines accompanying the results of the companies like Policy Bazaar and Uber almost always contains a reference to their adjusted EBITDA. A rational explanation of this surge in popularity is that the companies can better portray their operational performance after adjusting for abnormalities. Now let us see some of the ratios where EBITDA is a key factor. First one, debt service coverage ratio. This ratio assesses the company's ability to cover its current debt obligation from its operational profit. This ratio is often scrutinized by debt providers to gauge the repayment capacity of the borrower. Looking at Adani Enterprise as an example, with a debt service coverage ratio of 4.29, the company's operating profits can cover 4 times its current debt obligation. Any ratio below 1 indicates insufficiency of operational profit to cover its current debt obligation. The downside to this ratio is that the debt providers often confuse EBITDA with cash flow. While EBITDA is a good metric to evaluate profitability and operational efficiency, it is not always an accurate measure of cash flow. The second one, EBITDA to asset ratio. It is crucial for companies with asset-heavy balance sheets. It measures operational efficiencies in leveraging asset to generate revenue. Let us look at an asset-intensive business like airlines. Indigo's EBITDA to asset ratio for March 2023 stands at 13.41%, implying that Indigo generated a return of 13.41% on its assets considering its EBITDA. This is a substantial increase from 2.74 in March 2022, whereas Jet Airways EBITDA to asset ratio decreased from 0.49% to 0.21% for the same period. This implies that Indigo has been able to significantly improve its efficiency, while Jet Airways might be facing potential challenge in asset utilization. The third one, cash flow from operations to EBITDA ratio. This ratio shows the company's ability to translate EBITDA into actual cash flow, and hence it is a key metric that should be tracked. However, this ratio too has its limitation. In SaaS companies, subscription charges may be collected at the start of the service and expenses incurred over time. In this type of transaction, cash is collected in advance, showing an abnormal spike in the cash flow from operations, rendering monthly tracking ineffective. The notorious case of a tech giant Byju's changing the revenue recognition policy from recognizing revenue on the commencement of a contract to recognizing revenue on a pro rata basis over time of the contract resulted in metrics like the CFO to EBITDA became less meaningful, as operating cash flow remained high while reported revenue decreased. The fourth one, EBITDA to sales ratio. This indicates how much of the revenue a company retains after deducting its operational expenses incurred to earn that revenue. A higher EBITDA to sales ratio indicates that the company is able to optimize its cost better as compared to its competitors. Financial analysts use EBITDA multiple to determine a company's value by comparing the recent transactions of similar companies or industry benchmarks. The TTM EBITDA or trailing 12 months EBITDA is generally used for valuation of companies as it is focused on the most recent operating performance. EV by EBITDA or enterprise value by EBITDA is used to compare multiple investment opportunities. It examines the relationship between a company's EV and its operating profit. Thus, a low EV by EBITDA ratio will indicate that the company is able to generate more value for the investor and that it may be undervalued or priced at its intrinsic value, while the converse may indicate a potential overvaluation. EBITDA, no doubt, is very crucial metric for investors as well as the management. To an investor, EBITDA provides a snapshot of operational profitability and portrays a company's ability to generate cash from its core operations. For the management, EBITDA is a valuable metric as it aids in making strategic decisions and assessing debt servicing capacity of the company. While a higher EBITDA is a positive indicator, it is important to dive deep into what drove the rise. If the growth is due to an increase in revenue, it highlights the success of the revenue function in increasing market share or commanding better pricing. On the other hand, if growth is driven by cost reduction, it is essential to assess whether this stems from a decrease in core operational expenses or administrative cost. A reduction in core operational cost signifies an improvement in operational efficiency, while a decrease in administrative cost can also stem from non-recurring actions like layoff. Finally, a lower EBITDA is not necessarily a negative indicator. In case of a young company, it is natural to allocate more resources towards marketing and business development with the aim of supercharging growth and hitting much higher EBITDA levels in the future point of time.